Hi, welcome to the session on Introduction to Risk. I am Dr. Srinivasa, Faculty, School of Management, Sastra Deemed University. After listening to this lesson video, you will understand about the nature and definition of risk. Insurance as a tool to minimize and mitigate the risk of loss. Factors of risk measurement, risk classification, and risk management tools. Risk is inherent in all the activities we undertake in our day-to-day life, and it is a common and constant concern for all of us. Risk can be defined as deviation of actual results from the expected. We prefer to eliminate this risk altogether and live in a world of certainty, but complete elimination of risk is not possible. However, we can take steps to minimize or mitigate to some extent. We buy an insurance policy to mitigate the risk of loss. Life insurance policy is taken for family protection, and health coverage can minimize the risk of mounting medical bill. Property insurance policy. This policy is taken for protection of property from theft and damage due to natural calamity. Car insurance policy. This policy is taken for protection of our vehicles and damage due to accident. So we are trying to minimize the potential loss that we may incur upon occurrence of rather unlikely event of theft, damage, and loss of life. The magnitude of risk can be measured from the following factors. The probability of occurring an adverse event, and in case the event occurs, the magnitude of loss that it may cause. So, the risk level is measured by the combined effect of the probability and magnitude, that is, the product of the two. Risk can be viewed in two ways. A. Risk of small losses with high probability. B. Risk of large losses with low probability. Category A includes changes in stock prices, commodity prices, exchange rates, etc., where changes are small but occur frequently and almost continuously. Category B. Risk can arise due to earthquakes, tsunami, thefts, road accidents, etc., where the probability of occurrence remains low but can cause large losses. Even though the expected loss in two categories may be the same, the strategies for managing the two different types of risk differ significantly. In business, the management of risk is mainly confined to the event of small losses with high probability. Firms are exposed to changes in prices of commodities, exchange rates, and interest rates. With derivatives, we focus on the management of the risks that emanate from the conduct of normal operations of the business, that is, risk of small losses with higher probability of change. All tools of risk management focus on control of damages and insulate or protect the operations of a business from adversities. One may choose to avoid risk by not undertaking an activity at all. There are people who abstain or restrict from air travel because they foresee too great risk in traveling by air. Some people do not invest in the stocks because of high risk involved with the stock market. Rather, they prefer to invest in safe avenues like post office deposits. While some activities can be avoided purely due to high risk, it may not be possible to abstain from some mandatory activities. Not entering a business in order to avoid business risk is not a solution to the problem. Rather, it is a problem itself. One has to find better solutions to manage risk rather than avoiding the activity altogether. The option is to manage risk, which means to control the potential damage. Managing of risk. Now let us look at the ways by which risk can be managed. Another way of managing risk is by diffusing the risk across sources. Most network operators maintain redundancy by having alternative routes available in case one of the communication channels break down. By investing in different types of securities, one can protect themselves against fall in expected return from single investment. This is an investment strategy, which is also called as diversification of risk through portfolio management. The risk of failure of all investments simultaneously is lower than the risk of failure of single investment. Similarly, firms do not have single supplier or single customer to manage the business effectively. One can manage risk by transferring it to another party who is willing to assume it. Insurance company do not help to reduce the price per se. They merely assume risk on your behalf. They have no means of controlling the thefts, earthquakes, riots, etc., but offer insurance against these risks. It is the business of the insurance company to assume such risks as it earns an income by offering such products. Similarly, there are people who are willing to assume risk of other kinds in return for compensation. Risk as such cannot vanish from the environment, but gets transferred from those who want to avoid it to those who are willing to bear the risk for a price. Management of risk through derivatives commonly referred to as hedging. Hedging is fundamentally the transfer of risk from those who prefer to avoid risk to those who are willing to take it. Risk per se has negative connotations. It is perceived as something undesirable. However, if risk is perceived as an opportunity, it can convert potential pitfalls, into gains. Some people perceive risk as an opportunity that provides higher returns. Derivatives help to develop better perspective or understanding of risk. Although there is huge scope for misunderstanding them purely as an opportunity to reap profits quickly. In this session, we looked at some of the basics of risk and managing risk. In the classes to come, we will look at the types of risk. Thank you.